Equity Market Update, May 2021. Indian equities were buoyant during the month and Nifty 50 ended 6.5% higher than the last month. Equity movement during the month were driven by considerable drop in new and active cases in India, better than expected Q4 FY21 results, strong global recovery, rally in commodity prices, unveiling of large fiscal spending plan by the US government, receding concern on premature withdrawal of liquidity by US Fed, and moderation in US Treasury yields. While small caps outperformed, mid-cap returns were in line with large caps during the month. Most major sector indices delivered positive returns, with power, capital goods, oil and gas being the best performing sectors, while for healthcare, IT, FMCG and metal, returns were relatively lower. Global equities performance was strong, with most major indices in key countries delivering positive returns. FPIs were net seller during the first half, but turned buyer during the second half of the month. FPI sold net equity worth $0.4 billion during the month of May 2021. On a cumulative basis, FPIs during the first 5 months of CY21 registered net inflows of $5.9 billion compared with net outflow of $5.4 billion in the same period last year. Domestic equity-oriented mutual funds registered net inflows of INR 4,221 crores in April 2021, compared with net inflows of INR 12,399 crores a month ago. In the first 4 months of CY21, domestic mutual funds have recorded net outflows of approximately INR 4,150 crores, compared to net inflows of approximately INR 11,300 crores last year. Out of the results declared so far for Q4 FY21, results of sectors like auto, banks, insurance, chemicals, energy, and metals were better than expected, whereas that of utilities, infrastructure, and capital goods were largely in line with the expectations. Results of consumer staples, consumer durables, NBFCs, and pharma sectors were relatively below expectations. In Q4 FY21, the corporate profitability has improved significantly, driven by better than expected recovery in demand, higher realization, cost rationalization, etc. Specifically, lower provisioning in banks, improvement in execution in infrastructure, higher spreads in metals, etc. supported earnings. After delivering healthy returns between April to December 2020, rally in equity markets continued in CY21. While Nifty 50 has scaled new heights, one should view the same in context that over the past 10 years and 15 years, Nifty 50 returns are largely in line with nominal GDP growth. Further, during the period CY18 to CY20, the returns from Nifty 50 were polarized, with top 5 stocks contributing bulk of the returns. However, CY21 witnessed performance of the broader market improving. While rally has become broad-based recently, there is still considerable divergence in valuations across sectors compared to their long-term averages. The surge in COVID-19 cases in the second wave over the past couple of months has been significantly higher than last year. Further, strict lockdowns imposed by most states impacted the economic activity considerably. However, impact on equity markets has been relatively muted, and Nifty 50 has delivered over 6% returns since the end of March 2021. The key reason for this, in our view, is possibly the impact on corporate earnings of most major sectors is likely to be limited, and that too transitory. Further, adaptation to lockdowns has been better than last time. Specifically, global cyclical sectors like metals, oil and gas, etc. are not materially impacted due to local conditions. Impact on FMCG, pharma, telecom, utilities, IT, etc. is also likely to be limited. Large players in financial services stand to gain from likely lower provisioning costs. Technology is making them more competitive and possible increase in market share. While sectors like auto and other discretionary spends might get impacted, but their weights in Nifty 50 are relatively low. Interestingly, approximately 50% of Nifty 50 earnings is contributed by global linked sectors, which is IT, oil and gas, metals, and pharmaceutical. Again, global experiences of equities in US, UK, etc. during the second and third wave also indicate lower impact of subsequent lockdowns on equity returns. Outlook. As on 31st May 2021, Nifty 50 was trading near 22x FY22E and 19.3x FY23E price to earnings ratio. In our view, these are reasonable multiples, especially given the low interest rate environment and healthy earnings growth. Further, the gap between 10-year GSEC and 1-year forward Nifty 50 earning yield stood at 1.4 below its 10-year average of 1.7. Further, though Nifty 50 is trading near all-time highs, if one views the 10-year CAGR of Nifty 50, returns are essentially similar to growth in nominal GDP. In light of the above, in our opinion, markets hold promise over the medium to long term, and there is still good value in select pockets of the market. Improvement in corporate profitability, fall in COVID-19 cases and relaxations in restrictions, easy financial conditions and low cost of capital, comfortable external sector, supportive monetary and fiscal measures, etc. also bode well for equities. In view of the above, in our opinion, there is merit in increasing allocation to equities in a phased manner or in staying invested, as the case may be, for those with a medium to long-term view and in line with individual risk appetite. Resurgence of spread of COVID-19, premature unwinding of fiscal and monetary stimulus, surge in crude oil prices, higher than expected NPAs, etc. are key risks in the near term. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.